What's up, guys? So in today's video, I'm going to talk about 1031 exchanges. And if you're in the business, whether you're selling, leasing, managing, or investing, you've definitely heard this term before. So let's go ahead and break it down. So the first thing is, what is a 1031 exchange? A 1031 exchange, named after Section 1031 of the U.S. Internal Revenue Code, is a way to postpone capital gains tax on the sale of a business or investment property by using the proceeds to buy a similar property. It is also sometimes referred to as a like-kind exchange. The second thing to talk about are the rules of 1031 exchanges. So let's go ahead and break them down. A 1031 exchange is a tax break. You can sell a property held for business or investment purposes and swap it out for a new one that you purchased for the same purpose, allowing you to defer capital gains tax on the sale. Proceeds from the sale must be held in escrow by a third party, then used to buy the new property. You cannot receive the funds, even temporarily. The properties being exchanged must be considered like-kind in the eyes of the IRS for capital gains taxes to be deferred. If used correctly, there is no limit on how frequently you can do 1031 exchanges. So what exactly is Section 1031? Broadly stated, a 1031 exchange, also called a like-kind exchange, is a swap of one investment property for another. Most swaps are taxable as sales, although if yours meets the requirements of 1031, you'll either have no tax or limited tax due at the time of the exchange. To qualify, most exchanges must be merely of like kind. You can exchange an apartment building for raw land, or a ranch for a strip mall, or an office building to an industrial building. Whatever the exchange is totally fine. The rules are pretty relaxed. You can even exchange one business for another, but there are a lot of traps for the unwary. Now, the fourth thing to talk about is 1031 exchanges, timelines, and rules. The first timing rule relates to the designation of a replacement property. Once the sale of your property occurs, the intermediary will receive the cash. You can't receive the cash or it will spoil the 1031. Also, within 45 days of the sale of your property, you must designate the replacement property in writing to the intermediary, specifying the property that you want to purchase. The IRS says that you can designate 3 properties as long as you eventually close on one of them. You can even designate more than 3 properties if they fall within certain valuation tests. Now, the second timeline and rule is the 180-day rule. The second timing rule in a delayed exchange relates to closing. You must close on the new property within 180 days of the sale of the old property. The 2 time periods run concurrently, which means that you start counting when the sale of your property closes. For example, if you designate a replacement property exactly 45 days later, you'll have just 135 days left to close on it. Now, the third thing to mention is a reverse exchange. To qualify, you must transfer the new property to an exchange accommodation title holder, identify a property for exchange within 45 days, and then complete the transaction within 180 days after the replacement property was purchased. So let's go over the steps on how a 1031 exchange actually works. Step 1 is identify the properties you want to sell. Keep in mind, a 1031 exchange is generally only used for business or investment properties. Properties for personal use, like your primary residence or a vacation home, typically are not eligible. Step 2 is identify the properties you want to buy. The property you're selling and the property you're buying have to be like kind, which means they're of the same nature, character, or class, but not necessarily the same quality or grade. Step 3, choose a qualified intermediary. If you don't receive any proceeds from the sale, there's no income to tax. That's generally the idea behind a 1031 exchange. One way to make sure you don't receive cash prematurely is to work with a qualified intermediary, sometimes called an exchange facilitator. Basically, they hold the funds in escrow for you until the exchange is complete. Choose carefully because if the company goes bankrupt or flake on you, you could lose money. You could also miss key deadlines and end up paying taxes now rather than later. Step number 5. Keep an eye on the calendar. For the most part, you have to meet 2 deadlines or gain on the sale of your property may be taxable. First, you have 45 days from the date after you sell your property to identify potential replacement properties. You have to do that in writing and share it with the seller or your qualified intermediary. Second, you have to buy the new property no later than 180 days after you sell your old property or after your tax return is due. whichever is earlier. Step 6. Be careful where the money is. Remember, the whole idea behind a 1031 exchange is that if you didn't receive any proceeds from the sale, then there's no income to tax. So, taking control of the cash or other proceeds before the exchange is done may disqualify the deal and make your gain immediately taxable. Tell the IRS about your transaction. You'll likely need to file IRS Form 8824 with your tax return. That form is where you describe the properties, provide a timeline, and explain who is involved and detail the money involved. So that's the general idea of a 1031 exchange. There's a lot of moving parts, but if you're in the business, you have to be familiar with it. I'd love to hear from you. Feel free to send me a DM if you want to talk more about it or if you have any questions. If you find this content helpful, please like this video and subscribe to my channel.